Okay, good afternoon, everybody. Thank you very much for those of you on the east coast of Australia and our friends in New Zealand. Very much for joining us. Good afternoon, everybody. My name's Jonathan Wu. I'm the Chief Investment Specialist and Executive Director in China Funds Management. Today we have a very special webinar. It's outside of our normal cycle of monthlies. Today and tomorrow, we're presenting our portfolio managers and CIOs to showcase their capability and run a couple of Q&A style webinars. I'm joined by Gordon Ip, who you also see on screen. Gordon is the Chief Investment Officer of the fixed income team for Value Partners and has been with Value Partners for a decade now. And he is also the portfolio manager to the Premium Asia Income Fund. Over the last sort of 2 or 3 years, the interest in this particular strategy has grown a lot. And obviously the continual thirst for yield by investors is not letting up. And so that's why I thought it's a good chance to give Gordon the opportunity to present our case for fixed income to you today. So you see the standard disclaimer. A few housekeeping issues today. Today the webinar is recorded, so you'll get an email after this as attendees, and you can share that recording with your colleagues. You will be receiving CPD points of today's presentation. It's been accredited by the FPA, and at the end of the webinar, your internet browser will jump up and obviously give you a 3 or 2 question survey. Just quickly fill that out, and then we'll know that you were here till the end of the webinar, and therefore we can give you your CPD points. Also, in the GoToWebinar platform, you will see a questions box that we're monitoring at the moment, and I'll leave questions till the end. But please, if there's anything that Gordon is covering or I'm covering that you have a question on, please feel free to ask, and I'll try to fit it in at the end of today's session. And we hope to have you out of here or out of this room by about 1:45 Sydney time. So to give everyone a quick update, as you can see on my screen, for Value Partners, they're managing about $11.5 billion as at now. They continue to be a very, very strong player in the Asian equities as well as fixed income space. So we aren't a global manager. We do not espouse ourselves to be experts in global investing, but we are experts in Asian investing. And on the back of many meetings we've had over the last week with our portfolio managers, it is very, very clear to us that people are now grasping the concept that you have to be on the ground to be able to have the presence and also be able to have the contacts on the ground to find the best opportunities to monetize investors' capital. So that is supported by a 70-strong investment team, of which 11 is fixed income. And one of the really important things to note, as you can see on the screen now, in terms of the team, they are split very, very uniquely compared to a lot of the traditional fixed income managers. And our core principle of running fixed income money is the fact that we simply do not believe that traditional credit research agencies, i.e. Standard & Poor's or Moody's or Fitch, provide the value that's needed to investors, give them a true picture of how to invest in credit, especially in Asia. And there's now a multitude of examples of that of late. And if I get the opportunity, I might ask Gordon to speak about one right at the end that me and Gordon have been speaking about over the last couple of days. We are a 100% bottom-up manager. We're not top-down. So we are trying to find the best ideas that we can in order to generate the best value for you, to achieve that 6% per annum targeted distribution of 1.5% approximated per quarter, of which we have never, in our now 10-year history, as at the end of August, never failed to pay out at least 1.5% per quarter. And this is obviously a strong driver. Now, Gordon and his team, because they're bottom up, they don't espouse their philosophy to diversify 500 different corporate bonds, because you simply cannot track that. And if the GFC taught us anything, certainly you cannot achieve true diversification or proper diversification by investing in 500 bonds that you may not be able to cover from bottom up research capability. And the fact of the matter is, no matter how hawkish the US Fed wants to be, it is still in reality a long way away before rates go up. And so the thirst for yield is ever present. And the issue that we have going forward for investors is still this ultimate problem of, if you are considering to buy or invest an allocation of your clients' capital into bonds, you have to tell them very clearly that if you're investing in traditional bonds, i.e. government bonds, either locally in Australia or overseas government bonds, you have to explain to them that they have capital losses. They are simply looking down the barrel of capital losses. The total return is nice and it's still positive, but they're going to get a heck of a lot of volatility on the way through. What we are saying is that we have two ways to win in this portfolio. One way is to pick up a strong cash yield, which is still sitting around 700 odd basis points, as well as the fact that we have built a portfolio of bonds that are trading under par value. If you are buying a set of bonds that is above par value, you have to tell your investors that you better hope that the yield is the part that's going to cover up the capital losses that they're going to look forward to. And if we consider this is the 10-year risk and return chart now that we have against a lot of the popular fixed income strategies out there, and note this is 10 years of history, not forward looking, it's going to be a very, very big difference going forward, because over the last 10 years, we know structurally rates have been going down. And I'm very proud to show you this chart. This is straight out of Morningstar Direct. This is our track record looking at which quartile we sit in over different time periods, ending August, exactly our 10-year track record to the day. And if you look on every track record, we are either in top quartile or we are actually above the top quartile. Okay, we have an incredibly strong performance track record against the universe of funds. And on top of that, if you're looking for capital preservation capability against the bench, we have a 90% upside capture, meaning that 90% of the time when the market is going up, we outperform, and only 32% of the time when the market is down, we actually underperform. So it's also very lowly correlated against equities as well as other fixed income funds, and it produces the 6% since inception. So with that, I'd like to start asking a few questions of Gordon. And I'm going to hand control over to the team in Hong Kong. And please forgive me. Actually, no, I think Hong Kong has control of the slides as well. Can you just double check that, Chrissy? Yes, I think you have control over those slides. Okay, excellent. So Gordon, my first question to you. Yep, you can scroll. Yep, you can scroll. Okay, the first question to you, Gordon, is obviously the main feedback we get is that yield on the premium Asia income fund is attractive. As we all know, the risk-free rate in China is effectively the highest in the world amongst major economies. Is that the only reason why the fund's yield is so high?
Yeah, thank you, Jonathan, and thank you for having me today. So to answer your question, right, when you're investing in China, people usually thinking of China is one market, okay? But usually China, when you invest in China, you can basically think of it as investing in the onshore market, meaning inside China, so that therefore all the transaction will be denominated to renminbi. Or you can invest China via the offshore market. So in that case, a lot of these instruments will be denominated predominantly in US dollar. Okay. So to answer your question, right? Yes, the rate inside China is relatively high compared to the rest of the world because, as you may understand, the Chinese government is going through some tightening measure within the economy because they think that the economy is getting a little bit ahead of what they want. So if you look at the 10-year onshore China Treasury, those are hovering around 3% versus the US about 1.3%. However, as far as the instrument that this particular premium income fund is investing in, we are primarily invest in the US dollar offshore market. So therefore, the interest rate exposure is more tied to the U.S. Federal Reserve interest rate. Okay, so therefore, yeah, so the absolute yield is high, but it's only have an indirect connection to what's the onshore rate right now.
Okay, excellent. So, Gordon, what's obviously a big topic that everyone's talked about since the start of the year has been inflation, right? From your perspective, what's the view on inflation? And is that a risk in your view? And also, furthermore, is that a risk to our strategy in light of your view? And obviously, any slides, Chrissy, you can control it. So any slides you want to reference, you can make reference to.
Okay. I think, to be very honest, is not an easy question to answer because right now I think a lot of the market participants, they are still saying, or in particular the U.S. Fed, they are saying the inflation, if any, will be transitory. Okay, and but when people say it's not transitory, only because when they have seen this long enough, then transitory become non-transitory, right? But if you look at all the prices, right? If you pull up the Bloomberg screen, look at all the commodity prices. Anything from what you eat, what you buy from supermarket, to like precious metal, to industrial metal, even the coffee you drink, everything. If you look at year to date, those are up double digit, right? And also, if you look at the shipping rate, look at the BDI index, which is a barometer for the global shipping rate. We are currently at a 10-year high. Okay, there's simply not enough shipped to ship all the goods from country A to country B, because in COVID people still do shopping, but they don't do physical shopping. They do internet shopping, and therefore goods needs to travel a lot, more often within point A to point B. So with that, you kind of see that if that kind of bottleneck continue to exist, and the supply chain is not coming back online to the full capacity, one would start imagine that the inflation may not be actually as transitory as the Fed said, right? So this is right now we are still observing the situation, and in particular what caused the supply bottleneck and all these spike in demand is really the COVID situation. So from what we think, at least now, we really need to look at the COVID situation, and from there then you could see whether the inflation will be transitory or not.
Okay, and then sort of in the light of our portfolio, are you concerned about of your view on our portfolio?
Okay, now if you look at the bond market, right? Bond market is pricing off the treasury yield curve. Okay, the back end is basically market driven, driven by predominantly inflation expectation. But the short end is basically anchored by the Fed policy, right? And I believe that central bank globally, they will try to keep rates at a relatively low level. So and so when you look at our portfolio historically, we haven't been holding a lot of long duration bond. You look at our portfolio, we are always very short duration, something like around 1.5 to 2 years. So when I look at our portfolio, it is not a portfolio that will be very sensitive to interest rate move. But nonetheless, it is a portfolio that will be sensitive to credit spread widening and tightening, right? So if you believe that inflation gonna pick up and the global economy is gonna come back to normal, and people getting back to a normal life, exposing in credit is one way to do it. Even though interest rate going up, because in those kind of situations, I believe company will have a better environment to operate, and therefore it will likely translate to better corporate profit, and it should benefit for credit spread compression in those kind of environment.
Okay, excellent. Now, looking at spreads and the risk and reward, how does the Asian high yield market currently compare to Asia as well as US investment grade, which predominantly most people will look at because they will say that is a safer bet.
Hmm. Yes, I mean, okay. Look, you just mentioned capital loss, right? When you're holding government issue. Yeah, when people approach when they investing in bond, they will just say mainly from the credit perspective. I invest in investment grade because those are you know uh, blue chip company. They have a rock solid credit profile. However, when you look at a total return basis, when you buy a bond at premium, meaning if you buy a bond above par, so ultimately, at the end of the day, if the issuer does not go default, what you get at most is par. So that means the premium that you pay today is going to erode into your total return. So you may have a good income component in your bond portfolio, but your capital account is going to shrink because everything has to amortize down over time at maturity, right? So I think right now, in terms of making money in bonds, I think right now the it's going down the credit spectrum. I think is a much more interesting proposition for investor to consider, and in particular because of Asian. If you see these charts, right, this is the high yield bond credit spread of Asia versus that of the US and Europe. And as you can see, right now we are hovering around, sort of, more north of 800 basis point versus comparable high yield bond in US and Europe. Okay, in a way, because of COVID and also in particular because of the conflict between US and China, a lot of the idle money when they have money to deploy, they reluctantly or not, they will have to put in the sort of quote unquote safer area, which is in the current world is US in Europe, because oftentimes Asia and in particular China today are deemed as a little bit too volatile for some of the investors. So with that said, I think right now credit spread is wide, and also if you look at how it compares under control.
Chrissy, is this the right slide? Oh, okay.
17, yeah. Oops. Okay, so the previous slide shows is, okay, Asia at the current point is cheaper than US in Europe. Okay, how about Asia on its own? How cheap we are compared to its own history? In this case, going back the last 5 years, right? So as you can see, the slightly darker line is the credit spread of China high yield, and the lighter one is the Asian high yield. And if you look at the China one, right now we are currently at 3 standard deviation on the cheap side, and for the entire Asia, 2 standard deviation again on the cheap side. Arguably, we are, especially for China, we are back close to, sort of a March 2020 liquidity crunch level. What does a 3 standard deviation cheapness mean? Okay, if you bring back your statistic 101, you will know, a 3 standard deviation event, basically anything 99.7% of the time, things happen within the 3 standard deviation, up or down. Okay, so that means on each side you are left with 0.15%. So in the current market, that means only 0.15% of the time will give you a valuation cheaper than what we are today. So it is right now how cheap we are in this market.
That's really interesting because it's, we see these opportunities come up every once in a while. And I guess, even last year, Gordon, your description to me post the Much event was effectively that it was Lehman Brothers in 48 hours.
Yes.
And the fact of the matter is those are, and for people that have been following the fund for a while, that particular month when the fact sheets came out for the end of March, I think we still had a cash yield of around 700 basis points, but our yield to maturity was 16%, right? Like that's incredible. And anyone that obviously took advantage of those situations have done very, very well. Again, this is not a fund that you trade, it's a fund that you derive income from. But when you're trying to understand the market, what we faced in March last year was simply not a default risk. It was just a liquidity risk or liquidity drawn out of the market where all the losses were really marked to market and nothing to do with underlying fundamentals. So
Yeah.
Gordon, going back to the yield, oh, sorry, yes.
Go ahead. Go ahead. Yeah.
So going back to the yield context, and we get this question a lot by advisors, is how sustainable are the current yields? So we're sitting, 700 odd basis points in terms of cash yield. And hence, what is the sustainability going forward, in your opinion, of us to be able to continue paying 6% per annum, which investors have kept receiving, and a lot of advisors have always used the term with me, it's the gift that keeps on giving. Is it sustainable?
I think, to be very honest with you, Jonathan, I think with the current market situation, it makes me much easier to pay 6-7%, right? As you may know, the cash yield of the portfolio has always been above the 6% payout. The latest one as of the end of August, as I can see, is 716 basis points. So that means I can afford to leave 10% of the portfolio in cash and still be able to service the 6% payout on an annual basis. So because of the cheapening of the current market, we feel very comfortable to maintain at least a 6% payout to our investor, and at least in the foreseeable future. Yeah.
Okay, fantastic. From I guess that the current environment allows us to maintain that yield, but what about 2 or 5 years from now? I mean, do you still think we can achieve 6% distribution? I guess the simple answer would be technically yes, because rates are still low now, and technically rates is, at least the risk-free rate going forward, needs to get higher at some point in the future. So do you still think 6% is achievable, 2+ years from now?
I think a better question to ask is because when you look at 6% today on an absolute basis, it's very attractive, right? Because the rest of the world is basically giving you nothing, right? I think the 6% has to compare on a relative basis what's available out there, right? So if I tell you one day the U.S. interest rate is going to be 5%, obviously if I pay 6%, that wouldn't be enough, right? So in that case, if one day the Fed rate is like 5%, then hopefully I can give you 9% in cash yield by investing
Correct.
in the universe in our market. So I think the only time that we feel we cannot pay 6% is probably that the Chinese or the Asian high yield market is so popular that basically drive all the spread compression almost to zero, right? Or even through US credit. So that means the entire market will be very, very expensive, right? So I think as long as the market stay cheap and Chinese and also Asian credit is always cheap versus US and Europe because of a lot of reasons, right? In the past, it's because of unfamiliarity for Western investors to invest in this part of the world. So therefore, naturally, when they invest, they need some, sort of Asian or Chinese premium. So so in that case, the market is always cheap versus the developed market. So I think if that is persistent, I feel quite comfortable to maintain a cash yield level which will be yielding you a premium yield versus the risk-free rate, whether it's 0% or 3, 4, 5%.
It's quite an interesting way of looking at things, Gordon, because it's what you're effectively saying is, as long as people are scared, the people that understand, what our investment thesis is, will receive and be the biggest beneficiary of the income that is coming through and the total returns that are coming through. When the sector becomes overly popular and everybody's trying to get in, that's when it obviously becomes a little bit harder. And that's really no different to equities either. Everyone needs to be paid, within inverted commas, an Asia or a China premium. And people that are actually understanding that market, and especially the advisors that are on the line today that have followed us for and been investors for many, many years, actually do truly understand what we are doing here and investing in an unpopular market and capitalizing on that risk premium. So
This is
it's
yeah.
very unique.
This is absolutely true. As I say, it applies to investing. All the asset class, all the instrument. When you have a first mover advantage, when you get in early, you will get compensated very handsomely, right? Not just in our market. And it's just that, for a lot of Western investor, to be very honest, the China market is kind of hard to understand, right? So therefore, and we've seen examples that when you just go blindly on following the index, investing in Asia, China, you have chances of being burned, right? So I think in investing in Asia and China, the key is to pick name by name, bond by bond, not by a top level asset allocation to go buy everything that is available in this market. Issue selection, name picking is tremendously important in my view.
Fantastic. So from a sector allocation perspective, historically, we've seen the portfolio quite heavily weighted to the property sector. And at the same time, we've drawn some criticism from that despite the returns that we've achieved. But since COVID, that has actually materially come down, with other sectors now, having a much larger allocation within our portfolios. Can you sort of talk through the rationale behind that? Is it because of COVID? Is it because of a regulatory environment? And what is your take of the property sector going forward? Especially recently, we've seen, more crackdowns in that sector. A lot of people are concerned, is the property sector just going to collapse?
Oh, okay. Yes. So to answer your first question, yes, we did reduce our property exposure. As you can see, let me see, fast forward to 25. Yes, this one. As you can see, right, the blue line is our real estate exposure in this fund. So as you can see, we have been taking it down to the current level. The reason for that is there's a one reason is that you may know that as I mentioned earlier, the Chinese government is going through some tightening process on the entire society, and the property sector, as you can understand, will be one of the sectors that will be subject to this kind of tightening measure. And in particular, they have the so-called 3 red lines restriction, where the government outlines 3 conditions to control the leverage and also to improve liquidity of this developer. So from at the beginning of this year, we basically said this entire property sector will be subject to a pretty strong headwind in our view because of this tightening, and also because of the brewing, as you know, the China Evergrande, right? There's some sort of high-profile credit event in the Chinese credit market. Some involved in SOE like Huarong, and then the second one is China Evergrande. So these two will, it was our opinion that the entire Chinese credit market will be going through some pretty heavy headwind. So therefore, as caution says, we're just going to take down the property exposure because property proves to be usually quite high beta, and also property accounts for 60% of the universe. So therefore, in order to be more defensive, whether we like the sector or not, when we try to go on more defensive, property is one sector that we will cut. Okay.
I mean, the what you see for the advisors on the screen, this only shows from March onwards, so effectively the last 6 months. If we sort of wind back the clock to about 2 years ago, we were holding, from memory, Gordon, 60 to 65% of the portfolio was actually in the property sector. And so it's it's interesting that we're materially reducing. And I would guess if there is some structural headwinds going forward, a lot of people would still ask, why would we still have a fifth of the portfolio in property?
Sorry, Jonathan, can you repeat that question?
Oh, sorry, I may have broken up a bit. Yes. So if we sort of wind back 2 years ago, we had property exposure in the portfolio sort of 60 to 65%. And what everyone's seeing on the screen now, it's dramatically reduced, but we still have about a fifth of the portfolio in property. So if the sector is facing still headwinds and government crackdowns, why do we still have a fifth of the portfolio? Is it still safe? What elements are still attractive by having a fifth of the portfolio still there?
Okay, now to answer your question, let me bring in the situation of the three red line policy, right? So again, these are the three separate conditions outlined by the central government of China to control the leverage and also improve the liquidity measure for a lot of this company, right? So as you can see, we listed out the 2019, 2020, and also the first half of this year, okay? So when we come into this year, we are basically at the end of 2020, actually for most part of 2019, right? So yes, it was true that the entire sector will be going through some strong headwind. But not all property companies in China are created equal. Some are better, some are worse. As you can see, if you use the three red lines as a filtering to sort of separate out the pans on the pots, right? So as you can see, back in 2019, around a double digit 15% of the universe of the developer, they are breaching all three red lines, right? Okay, and close to 20% breaching two out of the three red lines, and the majority 63% breaching one of the three red line, and only a small amount of company they are satisfying all the restriction, right? So when we come into this at the beginning of the year, we are basically concentrated in buying property, some of the green and the yellow, right? So what we cut is the red and the orange, right? So therefore, that although we as a whole we reduce our property exposure, but I think the market is very good. Is that when the entire sector is not favorable, when people need to sell their position and bring the cash back, they usually they just sell everything, right? They sell the good name, they sell the bad name. So in this kind of situation, we are taking advantage of the market to buy good names in depressed valuation because of a lot of this selling from investor, in particular Western investor. So therefore, even though we reduce the overall property exposure, the quality, overall quality and the composition of our property holdings actually has improved.
Yep, no doubt about that. Just to remind everyone, there is the question box, and if anyone's got any questions, please ask about it. We have about sort of 10 minutes to go. There is a question that has come through, and it was actually my next question, Keith. So all good. Thank you for reminding me. Gordon, when we're in, remember we're in Australia, we're sort of a big island of 20 million people, and we don't truly understand what's happening in China, which is a huge economy with a huge complex construct is probably the best way to put it. We're just seeing headlines about Evergrande, and you sort of touched on it briefly a couple of minutes ago. Can you sort of explain what's happened to Evergrande? And to be clear, we have no exposure, and we never had any exposure to Evergrande, and we don't intend to. Gordon, can you sort of walk through what's happened with Evergrande, and are there any systemic risks?
Okay. Yeah, so we have been bearish on Evergrande for many years, and as you say, we don't hold this position in our portfolio. I think to sum up the incident of Evergrande is best summed up by a very famous saying from Warren Buffett, right? So he said, when the tide is high, right? When the tides are low, you know who has been swimming naked. Okay. So
Yes.
the best description for Evergrande, when a company expand too fast, too aggressive, and basically fuel their growth mainly by reckless borrowing. When the market turns, when the market becomes less favorable, then they will just expose themselves, right? And also Evergrande as a company, they other than doing property, they also have other uh, area of business too. So for example, they own a football club in China. They are also involved in electric vehicle. They are involved in some tourism. So to us, they are not as pure as a developer as most people think. So kind of we think that they are not very focused. They are just trying to make money, wherever there's an opportunity, and they finance this initiative by a massive amount of borrowing. So, as I say, China is going through tightening, and this is what the entire market dynamic will change. And basically, they expose themselves.
Yep. Yep. Gordon, I thought just as we're talking about, this the change in distribution of the portfolio allocation, I put up on the screen here the sector exposures. So obviously, a lot of the real estate exposure that's sort of come back has been allocated to transportation and materials and utilities. Could you sort of walk through why the change into those sectors, and you think it's quite attractive on a risk return basis?
Sure, no problem. Okay, so I mentioned property sector is going through some headwind. So although we can pick some good names in the sector, but nonetheless, we did have pared down our property exposure. The money coming back was we deployed into a couple of areas, basically in the non-property sector in China. And those sector we believe will benefit from, first of all, the current supply chain bottleneck. Number two is the reopening or recovery of the Chinese economy, and number three is the commodity price rallying, right? So when we deploy in the Chinese consumer, we basically deploy into names that will benefit from the post-COVID recovery. In particular, we have some position in car rental company, right? So when China reopen, although people haven't really gone back flying a lot, but they do become more of a driver there. So car rental business become booming in China. People tend to rent a car to drive from town A to town B. So that position has worked quite well in our portfolio. Number two is the supply bottleneck, right? So as I mentioned, the shipping rate is sky high right now. So we do have position in shipping and logistic company, and basically take advantage of the increased freight rates. Okay. And number three is the commodity. I mentioned, if you look at the Bloomberg screen, year to date, all commodity prices, they are in double-digit gain. Okay, so we do have some position in aluminum producer, iron ore, and some of the energy producer as well.
And so it is interesting that the sort of the topic you just touched on in terms of logistics and freight costs going through the roof. For those of you that are interested, we have our webinar with Renee Hung, the Senior Investment Director or Deputy CIO, tomorrow at the same time as today. And one of the themes that we will talk about is also shipping, because one of the strengths of Value Partners is that Gordon also spends a lot of time with the equity guys. So they do share ideas between the teams as to how to best capitalize and monetize different investments and themes. And while sometimes Gordon has differentiating views to the equities team solely based on the fact that as a bondholder it may not be good, but for the equity holder it may be fantastic. There's a lot of that cross-fertilization of ideas, and that's one of the questions that literally has come through. Gordon sits in amongst the rest of the equity team as well as his team. So the cross-fertilization happens full time. So when we talk about the investment team as a whole, whether it be multi-asset, fixed income, equities, and big data, which is the quant team, they all sit in the same area. So they're always cross-fertilizing ideas. A few questions have come through. What is the current research rating of the fund? So we are currently researched by one house and one about to come online. So SQM Research, so the guys that have a very strong track record in researching fixed income as well as property funds. We have a 4.5 star rating, and in actual fact, out of the broad range of global bond funds they rate, we are the one and only 4.5 star rated bond fund. So they've been on a research journey with us for 8 years. And so probably I'll get the team post this when we send the feedback, when we send the sort of CPD points and follow-up emails, we'll include that research report for you to access. Currently, we have a hot draft in our hands of a long sec report, which we are looking at completing in the next few days. So we expect that report to come out in the next week or two at the latest. We have a gut feeling of what that rating may be. All we can say now is that the SQM research report will probably be more useful at this current point for the advisors that are on the call. Another question has come through. What is the average security rating at present? So you can see that on the screen in the bottom left. This is by no means a reflection of the quality. And Gordon, please jump in if you think that I'm saying something incorrect. But regardless of what the bonds are rated, and you can see there that there's this section called NR, which is not rated. There's no such thing as a unrated bond means that it's a bad bond. And Gordon always reminds me, and over the many years we've worked together, that there's never such thing as a bad bond. There's only a bad price that you pay for a bond. Because if you have a piece of junk, if it's priced worse than junk, it might be a good opportunity, and vice versa. And so, Gordon, that's obviously another one of the most common questions we get, and sort of that's probably a good way to tail off the end of this webinar. Can you sort of explain to us, why fundamentally you believe that external credit research rating agencies and their ratings, one, you don't find useful, but B, it actually allows us to the ability to find more opportunity?
I think not being overly critical of rating agency, I think their rating do serve a purpose for investor as a barometer of the credit worthiness of the investor. But I think it's really key to understand when rating agency make rating change because they are the guy that people trust in. And whatever they move the rating, they need things to happen, right? They need things to materialize, become a fact before they either upgrade or downgrade certain credits, right? And in a way, it is not really forward-looking, right? If people just add after they change the rating, the market's already moved, okay? So in our team, our philosophy is to anticipate some of these rating changes through our due diligence work, all the on-the-ground research, with the company, and basically try to get information as much as possible and as quickly as possible so that we can move ahead the market, basically move ahead the rating change. So for a bond that is non-rated, you put it very good that not all rated bonds are bad, right? Although some are bad apples, but oftentimes company needs to pay for a credit rating simply because they need to gather the audience, right? As you know, if you market a bond to some investor and they say, oh, what's the rating? Oh, there's no rating, so I cannot buy, right? But in fact, a lot of the good company, we can see in Australia, we can see in Hong Kong and elsewhere, a lot of very, very good company, because of their brand, because they are household name, everybody knows, they don't really need a rating and still can sell the bond, right? Remember, the company, the issuing body needs to pay for the credit rating, both one-off at initiation and also on an ongoing basis. If the company do not need to pay rating agency to get their rubber stamp, these kind of cost saving will be passed on to the credit investor, right? So we acknowledge credit rating from credit rate agency. However, we don't operate based on their credit, both the initial assignment of the credit and also their rating action. Our job is to, we always do our own bottom-up due diligence work and come up with our own credit assessment. And as you say, that there's oftentimes that a unrated point in a way will give us, to put it plainly, free money in the market that we can just easily grab. But however, the key is to do your homework.
Correct, correct, and then that's the key thing, which is why we keep the portfolio, purely based on bottom up. We don't invest in a lot of bonds. I think it generally fluctuates between 50 and 70, depending on the opportunity set and how much cash Gordon wants to keep. And what you see on the screen is the translation of those returns, where we sort of generally are paying, and we've never paid less than 1.5% per quarter over the 10-year track record. So we have 40 observable periods of distribution, and sort of 30 June 2021 is the culmination of a lot of capital gains that were basically built into the portfolio because of COVID. And that's how we ended up paying 4.1% for the financial year ending June 2021. And just in the previous year, for 30 June 2020, 6% distribution was just by chance. A lot of Gordon's foreign exchange forwards matured on the 28th of June, and therefore we paid that out. So it's got a very, very strong track record of income. So if you're looking for that income solution, it's very, very worthwhile to speak to myself or Derek, depending on the state you're in or the country that you're in. And to give you an idea, I mean, our family, and why we stick very close to Gordon, and I talk to Gordon pretty much on probably nowadays a couple of times a week, is because we have a very large family investment of about $7 million in the strategy. So we seeded the strategy. We built the parameters for it to suit an Australian audience. And I guess, the final thought that I want to leave everyone with is that emerging market debt is an area that's growing. It's growing in interest, and it's also growing in interest because of that ongoing thirst for yield. And that's certainly not going away. But what is very, very important is that we are not the first people in the market to launch an EMD fund in Australia. But what we have seen across the market is effectively there are only 3 or 4 choices. I think that probably, including us, I think there's about 3 or 4 choices that are left. And even then it's split between sovereign debt funds and funds like ourselves, where we can invest in sovereign, but we also do corporate debt, which is generally where we can produce the returns. But our fund is fundamentally built for an Australian investor, and to a certain extent a Kiwi investor. We are not taking a US dollar off the shelf strategy and then basically putting in front of you and say, hey, here's a fixed income strategy, but you're going to have to take the risk of Forex. And that's sort of where a number of emerging market debt funds have sort of fallen from grace in Australia and have been pulled out of the market. So we espouse ourselves to be the one emerging market debt strategy in the country where we are actually managing it for an Australian context, just try to remove as much of that currency risk as possible. And that's exemplified by our volatility over 10 years of just over 500 basis points per annum. So that's very, very attractive. Now, I don't see any other questions online. I just want to thank, obviously, Gordon for taking some time out of your day to speak to us. And no doubt this is not the last time that we'll see you. We probably will bring you back in a couple of months and see how portfolio has continued to perform, and obviously the strong yields that's flowing through. So, ladies and gentlemen, thank you very much. Obviously, as I mentioned at the beginning, you'll say once you close the webinar, you will see a 2-question survey pop up. Please answer those 2 questions, because then we can deliver you your CPD points. And with that, I wish everyone a very good afternoon. And for those who's joining us tomorrow, thanks very much.
Thank you.